Hello and thank you for watching yet another online video tutorial and training brought to you today by lowvarates.com. Today we are going to talk about the VA hybrid loan, which is a very popular and very effective loan being used by military homeowners right now. But we're going to dive a little bit deeper and we're going to talk about the CMT index. And when you combine the VA hybrid loan with the CMT index, you have an absolute win-win combination. Now, before we can get into the CMT index, what a margin is, what a fully indexed interest rate is, you need to understand what the VA hybrid loan is. Now, if you're watching this video, you've probably heard about it and you're now doing research. And I thank you and congratulate you for doing that, because you do need to understand the hybrid. Perhaps the best tool out there, hands down, where you can get all the information you need to become an expert on the VA hybrid loan is at vahybridtruth.com. On this website, vahybridtruth.com, you'll get more videos like this, you'll get blog posts, and you'll get a lot of unbiased education to help you understand what the VA hybrid loan is. I need you to completely understand the VA hybrid loan before we start getting into the slide presentation. Okay? Now here are some basics that most of you watching this video probably already know. But first of all, a VA hybrid loan has a much lower interest rate than a 30-year fixed. You're never ever going to see a situation where at the current market, 30-year fixed rates are lower than ARM rates. It's just not going to happen. Or should I say hybrid ARM rates. If you were getting a mortgage at the exact same time on that day, your hybrid loan rates are always going to be lower than your 30-year fixed. Now, generally speaking, if you must have a fixed rate loan, why not get a 5-year fixed hybrid loan? That means you're guaranteed an interest rate. Right now that rate can be as low as 2.75%, and that's guaranteed fixed for the next 5 years. Now, if you're like most American homeowners, you're not going to be in your home. Or I should say, let me rephrase that. You're not going to be in your loan for 5 years. And that's what people get confused. You certainly may own the same home for 10, 15, or even 20 years. But go ask anyone, perhaps even yourself, that's owned a home for more than 5 years, and ask them if they've been in the exact same mortgage that they used when buying that home. You will struggle to find anyone, even yourself, because something always happens. You either refinance, or you move, or you do home improvements, which require you to change your loan. You will not be in the same mortgage for more than 3 to 5 years on average. So why are you so concerned about what your interest rate's going to be 30 years from now? It just doesn't make sense. And we get into that up at VA Hybrid Truth. Now, you can also pay your home off faster by using a VA hybrid loan. So let's start talking about the index. What is an index? Well, generically defined, an index is something that's been designed to track a particular market or asset. If you want to know how much gold is trading for, you can look at the gold index, for example. As it refers to mortgages, your mortgage index is a benchmark or a starting spot the interest rate of your hybrid or adjustable rate will be based on. Okay, so you've got a starting point. It's kind of like the benchmark interest rate where your hybrid rate will start. So let's start looking at the different types or kinds of indexes in the mortgage industry. The CMT index, which is for VA hybrids, and we're going to talk about that today, is hands down, in our opinion, the safest index out there. Next safest is the Treasury bill or the T-bill index. Most of your conventional loans are somehow tied back into the T-bill. Now, probably the least safe, in my opinion, the MTA, the CODI, and the COFI. These are the 3 indexes that loan officers were using when offering up these option ARM loans that have put our country into such a negative housing market. Those loans that most of you were scared at originally, that is not what we're talking about. Option ARMs are completely dangerous and completely different than the VA hybrid loan. And one of those reasons is because the index upon which they are based is not that safe or stable. Now let's start talking about the CMT, or the constant maturity Treasury. First of all, you got to understand that the VA and the lenders have gotten together and said, let's base our VA hybrid loans on this index because it's safe. They've chosen to give you the safest index. And it's safe because it's a 12-month average. Okay? It goes over an entire year and it averages out the changes in the U.S. Treasury. Now, anytime you take an average, it allows you to reduce big swings or fluctuations in your rate. So it gives you stability where other indexes don't. And keep in mind, it's an annual average, much steadier than looking at something that averages daily or even monthly. This is an annual average. Now, U.S. Treasury bonds, as most of you know, are the bonds that you usually hear about in the news or when the president's speaking. The Federal Reserve and actually China, Japan, all of the major industrialized nations in the world see the U.S. Treasury bond as a safe place to put their money. And the Fed is always on alert to try to stabilize and keep people buying their bonds. That should be a good sign to you that your interest rate is based on the U.S. Treasury bond market. Now, let's look at the current CMT levels and their effect on VA hybrids. So as of right now today, August 23rd, 2011, the CMT index this month is at 0.19. Now that doesn't necessarily mean that that's the average, but that is where it's at today. 1 year ago, it was at 0.29. So you can see even over a year period, there's a 0.1% change. It's a very constant index. And this is important in our example to notice this. Now, how does this affect VA hybrids? First of all, your index will start out extremely low. This is one of the lowest indexes out there. And that's why your interest rate on your VA hybrids is so low. Now, you have to understand what a fully indexed rate is. Why aren't you being offered a 0.19%? If I'm saying that's what the CMT is today, why aren't you being offered that? Well, lenders take the index and then they add a margin. That's kind of their spread or how they make money. You ever been to Vegas and they say, well, the house has a spread, the house is always going to win? So is the bank. The bank might be getting the money at 0.19%, but then they're adding a margin on and they're fully indexing your rate. So this means your rate, when it does adjust 3 or 5 years from now, it will go up or down, okay, based on what your index, the CMT, is doing at that time, plus whatever the margin is. Now we're going to dive into this a little bit deeper. Suppose you got a VA hybrid back in August of 2008. In August of 2008, the CMT was at 2.18%. And rates were being offered at that time by loan officers like the one you're working with now. They were offering 4.25%, 3.1 hybrids. Fixed rates were around 5.5% or 5.75%. That's about 1 to 1.5% higher than what you're getting now. If you're looking at getting a VA hybrid loan today, like I said, rates are down around 2.75 for some and 3.25 for everyone. Okay? But in 2008, if you got a hybrid, you would have been at 4.25, which still would have been lower than the 30-year fixed rate at that time. Now, here we are 3 years later, and your loan's about to adjust. What a lot of people think is, oh my goodness, that's scary. If I'm still in my loan 3 years from now, what's going to happen? Well, first of all, your rate would go from 4.25% all the way down to 2.44. Now, I got to fix something here vocally. It can never go up, as you've learned from your loan officer or from watching videos on VA Hybrid Truth, it can never go up more than 1% a year, and it cannot go down more than 1% a year. So just like you have protection on the upside, the bank has protection on the downside. So this should actually say your rate would go down to 3.25%. Even though mathematically it should be this low, there are some caps in there. You cannot go any lower than 3.25% on your adjustment if you had gotten into a loan in 2008. Nonetheless, that's great news. Now, why is this? Well, the CMT today is 0.19. Your margin of 2.25, and some banks, even here at low VA rates, we do have the option sometimes to get you a lower margin. You can see how this margin affects your adjustments up and down. A 1.75% margin would even give you a lower rate, but don't forget, you can only go down to 3.25% anyhow, so don't let this margin, most of the time you're going to be at a 2.25% margin. But you take 0.19 plus your 2.25, and that gives you the 2.44. So that is your fully indexed calculation. If you want to fully index your rate, that's how you do it. So give us a call toll free if you're not already working with us, 866-569-8272, or keep working with your loan officer who has sent you this video. You should now be an absolute expert, and there should be no reason that I can think of that you're not ready to pull the trigger on your VA hybrid loan. Thanks for watching.